5-year breakdown of SPLG, our third ETF. If you're watching this, it's because you know it's time to get your hands dirty and begin the next chapter of your life. The $1 Investor, creating wealth $1 at a time. SPLG, 5-year outlook and Wall Street. Take the SPDR portfolio. S&P 500 ETF, ticker SPLG, is a passively managed, ultra-low-cost exchange-traded fund designed to mirror the performance of the S&P 500 index. The fund launched in 2005, November 8th, and is managed by State Street Global Advisors. With an expense ratio of just approximately 0.02%, it ranks among the cheapest ways to access large-cap U.S. equities. Why SPLG may perform well over the next 5 years? 1. Broad market exposure. Since SPLG tracks the S&P 500, it gives investors participation in approximately 80% of the U.S. equity market capitalization. That means as the U.S. large-cap market grows, SPLG participates. 2. Low-cost advantage. With fees near 2 basis points, investors keep more of their returns, which compounds meaningfully over long horizons. 3. Large-cap stability and scale. The S&P 500's largest constituents exert outsized influence. For example, the top approximately 25 stocks may represent nearly half the weight in SPLG, which gives exposure to mega-cap growth and cash-generating businesses. 4. Holding period potential. Over the next 5 years, if U.S. GDP grows moderately, corporate earnings rise, and valuations hold, SPLG stands to deliver broad market returns of perhaps mid-single-digit to low double-digit annualized, including dividends. Given the historical S&P 500 return, including dividends, has averaged in the approximately 10% range over long periods, a somewhat more conservative scenario, say 6 to 9%, might be realistic now. Headwinds and risks. The fund is market cap weighted and thus exposed heavily to the largest names. A stumble in tech or mega caps could disproportionately hurt performance despite the diversified label. Because it's essentially owning the market, it has no protective tilt. In major downturns, SPLG will decline with the broad market. Low cost is an advantage, but in a world where many markets may deliver lower returns, cost alone cannot compensate for weak underlying fundamentals. Valuation risk. If U.S. equities are priced for perfection and that slips, returns could be compressed.